Hello, everyone, and welcome back to Sudden Wealth. I hope you had a wonderful end of the week. If you do enjoy the content, please consider dropping that like and subscribe. Thank you very much. So today, I would like to address a little bit the behavior in the stock market because we've been seeing quite a bit of volatility. We were green for the majority of the day. Then some economic data comes out worse than expected. You may recall this. I actually just mentioned this in my live stream yesterday, which is when everybody was telling you about recession, then you shouldn't be concerned. But now that the Fed, Goldman, Bloomberg, CNBC are starting to say, to raise their forecasts and basically saying there's no way we're going to get a recession, now it's the time to get concerned about the recession. See how it works? Not when all of them are preparing for it, then it never happens. So you always need to assume that these people are always wrong. So if they are telling you now that there's not going to be any recession, now it's the time to worry about the future recession. Now, what's been happening is actually quite simple. If you guys have followed some of my videos, this has been mentioned many times. I do think we are still in a sideways pattern where 4,250 is kind of the extreme of the low on the S&P, and 4,600, 600 something, it's on the other extreme on the upside. And the majority of the time, we end up being between 4,300, 4,500, around those levels. So as long as we don't break decisively below 4250 on the S&P, things should still be fine. Now, what is driving all of this? This is the most important part. Is not Fed Powell's comments. It's not the liquidity crisis again or the banking crisis. No, it's the big sell-off in the bond market. You see, the US debt is growing at a brutal pace. So we just passed $33 trillion in debt, and we've already added in 1 day or something, or 2 days, $50 billion of new debt. Just to put things into perspective, that's $800 plus million per hour. That's what it means. So this is always, and that, by the way, I was reading CNBC because you may recall what I've mentioned when people were all projecting that the Fed and the central bank, the ECB in Europe, was going to cut rates. Do you remember what I said? If they can, they want higher rates for longer. Basically, higher for longer. Get my surprise when I'm reading the CNBC article and say, traders in Europe have mixed reactions to the higher for longer stance of the ECB. So these guys that have thousands of analysts doing nothing but this kind of work, they couldn't see it, and I've been telling it to you for months. They've been telling you what they want to do. It's very clear. They want to be able to cut rates whenever we actually have a serious recession. That's it. That's all they want. Now, the problem is we are accumulating deficits, both on the trade side and on the budget side, which means these higher rates are starting to really hit us. And the problem is because of the behavior of the United States against certain countries in the world, I think all of you guess which ones they are, it's making it very appealing not only to enemies of the US, but even allies, to get away from US dollars. So what's happening is you have the Treasury issuing a lot of debt, plus the Federal Reserve selling bonds, plus enemies and allies looking to get rid of bonds as well as much as possible in order to get away as much as possible from the US dollar. So the point is, if the bond market gets very volatile, particularly to the downside, then it brings all the other markets with it. It's very simple. Why are stocks going down? Did things materially change to the point to justify all this downside? No. This is what happens when the biggest market, by far, starts to show signs of cracking. Then the other markets suffer by extension. Now, and here comes the exception. I do believe that if we do have talking about a big crash in the bond market, I do think in that scenario, it will derail my all-time high prediction for the S&P 500, Dow Jones, and Nasdaq 100. And it will cause, in my opinion, in the beginning, big sell-offs in the precious metals and in the crypto markets. Why? Because in times of distress, people sell what they can, not what they want. Because both these assets are an edge against a collapse of the fiat system. Because both of them, to a certain extent, are alternatives to the existing money system that we currently have. Now, I'm not saying that this is going to happen. I am not predicting the end of the world. What I'm saying is, forget about this liquidity crisis, commercial real estate, banking. No, the problem, if there's going to be a big problem, will come from China or from government debt, not from things that everybody's expecting. And how does this impact, I would say, my prediction? So far, nothing. As I mentioned, as long as we remain above the 40 to 50, we are still in that sideways movement. We are just approaching the extreme side of the downside part of that channel. But other than that, I haven't seen many changes. I do think there's a big fear of higher inflation because of the oil prices, but the oil prices should be peaking, in my opinion, sometime around September, October, which means that if they go down, then the rest of the expectations on inflation go down, then you don't need as many rate hikes, blah, 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 all of these things. But in any case, it's important to be aware of what's happening in the market. It can be very important, or it may be just a phase. The people who are not happy at all are, of course, Harry Dent and Steven Van Meter, who have been recommending people to buy TLT when it was 160 and 170. So congratulations for all the diehard followers of those guys who keep defending them, because unfortunately, there's a reason why Steven Van Meter needs to pump garbage stocks on a daily basis in exchange for $6,500, and he needs to pump them to his following. You should ask yourself why such a successful visionary investor needs to do it. Think about it. Thank you very much, guys, and I'll catch you in the next one.